Hey everyone, my name is Eric Bond, and I'm one of the co-founders at Hustle Fund. Welcome to today's session, which is called Finance 101 for early stage B2B startups. All right, so at least once per week, I find myself getting fooled. You can imagine that as a pre-seed stage investor, you hear these founders who come in, they're pretty early on, and at some point they'll just sort of casually drop that they're making like $1, $2, $3 million of annual recurring revenue already. So I'll do my best to put on my poker face when this happens. But the problem is, if you ever played poker with me, you know that I have an overly expressive face that like sort of twitches like this when I'm bluffing. And in my inner monologue is basically saying like, oh my gosh, I am so thirsty for this deal. They already have this kind of traction and product market fit. Oh my gosh. So, the pitch is awesome that the founder gives and everything looks great. And then I look at the numbers a little bit more closely and realize that that revenue that they're talking about was actually bookings. That's like a liability. That's not necessarily income yet. Side note, if you have a lot of bookings, that's still pretty impressive early on, but we can talk about that later. So, the issue, what we found in this situation was just like the founder actually just didn't know the difference. And it's not a knock on him or her that they didn't know the difference. It's just something that founders don't really spend a lot of times thinking about in the early stages of their companies. At least a lot of them don't. Many founders that we speak to are a little bit more product oriented or user experience oriented, and that makes sense. But it's very important, I think, especially for SaaS businesses, to have a good handle on what are the core business metrics that you need to understand, even on day one, in order to build out your going concern later on. So today, we are going to be going to school, and it turns out that we have an incredible teacher named Miran Ahmad, whom I'm going to introduce in a moment, but he is an incredible finance executive, longtime finance executive, and he's going to walk through some of the finance 101 basics that your business, that you'll need to know about your business to get a better handle on the health of it, as well as to look good in your fundraising process so we don't have that weird kind of awkward exchange when you're actually pitching with me in the future. So let's go ahead and take a look at the agenda. So really quick, gonna just super breeze through the introduction of Miran. He's a super awesome dude. I'll hand over actually, or we'll actually move into the slides that he's put together, talking about some of these basics. And hopefully that's about 25 or 30 minutes or so of content. And then we're gonna leave plenty of time for Q&A. So for the Q&A, just a little bit of logistics here. We're using a Zoom webinar platform. The best place for you to put your questions is in the Q&A box. We're also joined by actually our head of product and engineering at Hustle Fund, Mike, who's serving as our producer today. He's going to help to sort through some of the questions, and we're going to try to get through as many as possible. So by the way, if the chat is really fun, but we're not going to be able to monitor that because there's going to be a lot of you here. So again, questions in the Q&A, but please use the chat. I mean, it's a great way to sort of vent a little bit. If you want to make fun of me, have snarky comments about us, go ahead and put those there. And maybe actually a good place to start, because we have an awesome community of folks who come to these events. Share your location. Let folks know what you're working on. Just see who else is in the audience. Encourage you to do so if you're so inclined. All right, so before I move on to introducing Miran and talking about and having him actually lead this content, I do want to give a shout out to Netsuite, which is they're our sponsors for today's session. At Hustle Fund, we actually don't put these monthly webinars on in an island ourselves. We actually have to rely on the support of some great sponsors like Netsuite. And I want to share a little bit about what they're about. So building a successful business starts with strong financial management. Without a clear view into your financials, you can easily overlook bottlenecks that keep the company from securing the funding it needs to keep pushing forward. Netsuite gives early stage companies a robust financial platform that provides a singular view of the business. Startups are equipped with real-time financial visibility, KPIs, workflows, dashboards, and built-in financial reporting capabilities that quickly and easily illustrate your momentum and progress to investors like Hustle Fund. So with rapid implementation and industry-specific functionality, Netsuite ensures you have the financial platform necessary to take the next step from day one. To learn more about NetSuite's financial management offerings for startups, visit netsuite.com. Thank you so much, NetSuite, for all your support in the past year and moving forward. So what I want to do next is actually talk a little bit about our esteemed teacher today. His name is Miran Ahmad. A little bit about Miran. So he's an ex-investment banker turned finance executive, has been a CFO at a number of awesome companies, and most recently was the VP of Finance at Truepill. So Truepill, by the way, is a rocket ship in the health infrastructure space, doing super awesome. As I like to describe my friend Miran, he brings the sass in sassy, and he's just like a really hilarious, nice human being who appreciates dad jokes, just like myself. And Miran, thank you so much for joining us today to talk about this topic. And also, just another quick shout out to NetSuite. I heard actually you were the guy who brought NetSuite over to Truepill. Hopefully that was a good user experience for you.
Yeah, I had a really great time interacting with NetSuite, really professional from start to finish. What I really appreciated was the NetSuite team really deep diving into our business. Truepill and pharmacy in general is kind of complicated. There's a lot of moving parts. So they really took the time to get to know us. And then the people I dealt with were really professional, right? Acted with integrity, everyone from sales to implementation, and everyone worked to get us the best deal possible. So, just shout out to the NetSuite team.
Awesome. Thanks for hooking that up, NetSuite. Listen, man, we are excited to learn Finance 101 from you. Please teach us and make us better. I'm going to control the slides for you, so let me know when you're ready to move forward.
Awesome. Let's get started.
Okay, let me make that work. There you go. Not this one. There we go.
What does great look like? Eric, this was the question that kind of started it all. We've been chatting about this topic for a few months now. And I really actually appreciate you asking me before and not asking me kind of during this Q&A, because it took me some time to really think through the answer. And so I don't have to answer this during the open Q&A section. So let's take the next step. So my take on what great looks like. On a tactical level, if I can teach you, the founders, something new and just inspire you to learn more about your financials, that's a win, right? Look, this is a Finance 101 course. I have you for 20 to 30 minutes. If I can inspire you to ask better questions, maybe even awkward questions to your finance and accounting professionals, then for me, that's an absolute win. Many of you may be using external accounting firms, so like Bench, Pilot, Formation, Escalon. There's a kind of a community of kind of outsourced accounting firms. Go talk to your reps and have them sit down with you and walk you through your own financials if you haven't already. That's my first advice. And just remember, they work for you, so get the most out of it. If I can continue that kind of love and appreciation for your financials tomorrow, I want you to start building that financial review muscle, right? And you don't need to know everything. One of the things that I get questions on, like, how do you know it so quickly? So this is what I do, breathe in, day out. But nobody knows your business better than you. So in the medium term, by continuing to ask those questions and getting involved with your own financials, you'll start to create this like mental model of your own financials. And before you know it, when someone presents you the financials again, you'll feel like a disturbance in the force if something isn't right? You'll be like, I don't know exactly what's wrong, but this doesn't feel right. That is a great sign, right? That means you're actually building, you're getting involved. You kind of know where it should be and shouldn't be going. And then kind of the end game, right? If those two are the inputs, getting involved with your own financials today, getting involved with your financials tomorrow, are inputs, what's the output? And for me, it's exceeding investor expectations when it comes time for fundraising or during like an M&A event, right? If getting you, Eric, I think you would agree with this. The cleaner the financials, the more fluent the founder is with their numbers. I think it leads to better outcomes, higher valuations, and better term sheets.
Spoken like a true VC.
Yeah. Now, from a corporate level, what does great look like? I think it looks different at different stages. And you can see from my very scientific chart on the right-hand side of kind of investor expectations is kind of early stage company, you're a Series A company, the bar's pretty low. It's, can you regurgitate basic information about your company, right? Series B, you got to be a little conversant. And Series C, you have to be pretty fluent with all the numbers. And I think what catches a lot of founders off guard is that the expectation is not linear. It's very it curves very steeply as you get to your later stage companies. And so for me, what does great look like? If I can have you as a Series A company acting and talking like a Series B company, like that's the gold standard for me. The second question ends up being like, why not be an A company and talk like a C company? You may end up spending too much time with your financials and you may be neglecting maybe product and engineering. Maybe you're still working out product market fit. I would love that, but really, if I can get you talking and acting like the next step, I think you'll be well ahead of the crowd. All right, so where are we going to jump off, Eric? Next slide. The golden formula. No conversation about finance would be complete without talking about accounting. And I'm sorry to spring this on all everybody. But this is, a Finance 101 course, and finance and accounting are two sides of the same coin. I really got to make sure everyone's on the same page. So it all begins with assets equals liabilities plus shareholders' equity. Okay. And the three financial statements basically are going to help you figure out what's going on with your business, right? The income statement is going to say, hey, how much did I make over this period of time? How profitable am I? Where did I spend my money, right? Moving on to the balance sheet, it's going to tell you how much money do I have right this second? How much do I owe X? And how much do people owe me? And then lastly is cash flow statement, right? Which is telling you over a period of time, where did my money go? Right? I think as a startup founder, that's probably going to be the most important, right? The cash flow statement will help you figure out literally the change in your bank balance and tell you, hey, how did I make or lose money, or where were my sources and uses? And the thing is, the three financial statements really answer three different kind of questions. So depending on what you're looking for, you can kind of start to navigate which statement you actually need. Okay. Next slide. The financial flow, right? This is a pretty basic version of how the financial statements are interconnected. There are many, many more arrows I could have kind of interjected in all of this. And I know you know this, but remember, everything you do as a company eventually gets translated somewhere in these three statements, right? You raise some money, there's cash, then there's equity on your balance sheet. You generate some revenue, that's your income statement, it goes straight down to net income. From net income, you can see it goes to your balance sheet, it also goes to your cash flow statement, right? The conversation we're having today is about SaaS. And so, one of the things that's very unique to SaaS is oftentimes you get prepaid in advance. So you'll sign a 1-year contract and you'll get all this money up front. Well, what are you going to do with it? Is it really revenue, as kind of Eric alluded to before? Unfortunately, the answer is going to be no. So you've collected all this cash and you've only generated a little bit of net income. Well, where's the offsetting entry? And that's a great question, by the way, for any of you guys to start, is what's the offsetting entry? It's something I still do. When someone's explaining journal entries to me, it's literally ask what's the other side? Because again, it's assets equals liability plus shareholders equity. It's an equation, so it always has to balance. So in this case, the answer is deferred revenue. So that's where you're going to see this giant liability. You're going to basically hold this cash on behalf of a customer until you've earned it. The last point I kind of want to make is all these financials being interconnected means if there's an error in one part, there's probably going to be an error somewhere else, right? If you don't have the time to really deep dive and get to an answer, the best next thing I can do is take some notes and email yourself like, hey, I think there was a problem this month and kind of like in this area, because that gives your first finance hire kind of a place to look. You took some contemporaneous notes, and at least that gives me a reference point to kind of work with. Okay, next slide. Please mind the gap. Any discussion about finance accounting has to include a quick chat about the regulatory environment. If you're US based, that means GAAP. First, you really just need to know that GAAP is a set of accounting principles. It's an accounting construct, and it may not actually match economic reality. Think about Mercedes-Benz or Coca-Cola or these really big brands with massive worldwide recognition. That doesn't show up on their balance sheet anywhere, right? Some may make the argument that it shows up in their pricing. They have better pricing than their competitors, but you get what I'm saying. What you have to realize is that GAAP wasn't created to reflect economic optimism, right? It was really created to ensure that investors get an accurate and kind of representative set of financials. And accordingly, GAAP tends to err conservative. It's quick to write off, but slow to upward revise. Second, as founders, you're responsible for the company, and accordingly, you're also responsible for the financials. Understand that GAAP is like a two-way highway, right? We, your friendly neighborhood, finance and accounting teams, we have some discretion. We have some wiggle room where we can kind of flex and push the envelope, but we have to stay on the road. Please don't ask us to go off-roading proverbially, because we're not going to join you. And third, and you'd be surprised how often I get this question, is what happens if I don't want to follow GAAP? Right? It's a bit penny-wise, pound foolish, right? Going back to the previous kind of investor expectation slide, investors are really expecting you to be GAAP, by your C, you're going to get these questions, flat out, are these financials GAAP or not? And if you want to go IPO, it has to be GAAP. You want to get bought, GAAP, right? And believe me, investors or a potential acquirer will definitely haircut your financials if they're not GAAP, because they just don't know kind of what's lurking.
Actually, a question on this. So you mentioned if you're US oriented, we actually have a pretty international crowd here today. So what are your thoughts in terms of if you're based in Europe or Africa, other kinds of markets?
Yeah. So depending on where you live, they have some sort of regulatory environment. There is a kind of international standard, IFRS. They are slowly kind of merging together. So there are regulatory bodies that are trying to get closer. Obviously there are GAAP to IFRS reconciliations or vice versa. So it's not the end of the world. You can definitely, be compliant with your current local regulatory regime. And there are ways that you can present your financials to external investors who may not be familiar with that format, or where certain things are regulatory, from a regulatory perspective, you have to put them in somewhere, but from a GAAP perspective, say you don't.
Very good.
Okay, great. Okay, next question. So Thanos, but in all seriousness, look, just like you needed time to devote to engineering and product engineering design and other parts of your business, I'm hoping to inspire you to at least devote a little bit of your time to your financials, because I'm inevitable, right? Eventually you're going to hire me or someone like me to be your first finance hire, right? And I'm not cheap, and I charge by the hour. And I'd rather spend my time playing offense with you and really helping you think about business development and the forward-looking model and sales or BD or whatever it is where I can be helpful, than cleaning up financials, chasing invoices, chasing AP. Like, for me, it's a lot more fun to help kind of grow the value of the business than to kind of just keep the books and records clean. That's it. And then I go home at the end of the day. But tactically speaking, I don't want you to put yourself in a position where someone like me comes in and materially cleans up your financials, either positively or negatively, because that's a bad outcome either way, right? If the numbers were overstated, right, and now I've come in and I've cleaned everything up and they were overstated, you may have to explain that to your board or to investors, saying, hey, I fundraised off these numbers, but it wasn't so. If the numbers were understated, you may have left money on the table, saying you may not get yourself all the credit you deserve. So I'm going to pause there. If you want to switch to the next slide, we're going to take a 2-second pause. Next slide. Because, that was a lot to process. Half of you, I'm sure, having PTSD and flashing back to kind of accounting class, and the other half are kind of still processing the journal entries I was talking about earlier. So let's take 5 seconds, because we're about to actually switch gears into the finance section. All right, let's do it. All right, so we've talked about basic accounting things: assets equal liability plus shareholders' equity. We talked, what does good look like, and a little about GAAP. So what's the first thing you notice about this slide? One, you should notice it's not exhaustive. And there are a lot of non-GAAP metrics, right? And here are a couple points about the non-GAAP metrics. 3 slides back, I said that GAAP was an accounting construct and may not match economic or business reality. This is where non-GAAP numbers and metrics can be very helpful and can provide context to a business that aren't properly captured by GAAP, right? Bookings is probably the most used one in the SaaS side, right? Second point is, even though non-GAAP metrics don't have a regulatory source, right? So there's no like government saying you have to do it like this or that, like kind of how GAAP gives us guidance. There are still common kind of acceptable definitions. Major VCs still often publish or blog about how they think about things. And Eric, you'd asked me kind of, what does good look like here? And I don't have an opinion really on that, because, each investor kind of has their own flavor. but I definitely have an opinion on what's kind of bad. I think if you take a non-GAAP number like an EBITDA and start to adjust it after that, it starts to raise red flags for me, right? And I think you've seen this a few times kind of as companies go public is, you're taking it's adjusted EBITDA. Now it's community adjusted EBITDA. You're stripping out a bunch of things. Well, that's a red flag. Okay. And the last point is, look, understand there still may be differences between investors. So pick a methodology, pick one of the bigger ones, pick a methodology, understand why it's relevant for you and your business and stick with it, right? One investor may include X in their LTV CAC, one may not. Okay. Another great one is kind of contribution margin. One may calculate it this way, one may calculate it the other way. Okay. But it also kind of brings us back to GAAP. For all of GAAP's shortcomings, at least we have a formal understanding of like, this is what like GAAP revenue means, right? So, there is some value to having a regulatory source. This being a Finance 101 course, so let's go to the next slide. I'm only going to really kind of go over 5 kind of the more important ones, I think, out of that entire list. Again, because these are non-GAAP terms, definitions can and do vary. So a perfect example for bookings is, should it include non-recurring pieces like implementation fees? Some people say yes and some people say no. For purposes of this discussion, this is how I kind of think about bookings: total contract value, billings, recurring revenue, and LTV CAC. So bookings is a forward-looking metric detailing the commitment of a customer to spend money with you. There are different kinds of bookings. There's new versus renewals. What's a really big pro of bookings? It's easily quotable, measurable, right? Eric, as you mentioned, I have $3 million. It's easy to like drop that into a conversation. $3 million of bookings. What's a big drawback of bookings is it doesn't tell me anything about the duration of your contracts. If you say, hey, Miran, I've got $3 million in bookings, maybe those are month to month. Maybe those are multi-year and you've got these people locked up. You can still quote the same number and you have kind of no idea about the duration. Total contract value, very similar forward-looking metric, generally reserved for multi-year deals. And so, if you've landed that 2, 3, 4-year deal, you can kind of quote a bigger number. Same kind of problems with bookings is you can quote a really large number, but then I don't know how long, so you may have to tell me like, oh, it's over the course of 4 years. Billings, it's probably the most straightforward and hardest to game, which is why I love it. It's literally, what did you collect in cash, right? You can quote me all the bookings you want, but if they aren't paying you cash, then we've got an Enron problem. Recurring revenue, value of the subscription piece, whether it's monthly, which is MMR, or annualized at ARR. This clearly excludes any one-time implementation fees, setup fees, any of that kind of one-off stuff. And then lastly, LTV CAC. This is generally more towards B2C businesses. You don't see this too much in B2B, but it's basically the ratio of capturing kind of the numerator, which is the value of your customer, over how much did it cost you to like actually acquire them. If you are in a B2B business, there are offshoots you can kind of do. You can replace the denominator, which is customer acquisition costs, with maybe sales salaries and commissions, right? To get some sense of like, okay, the value of the contracts they're landing versus how much are they bringing me in. Kind of heuristically, LTV CAC less than 1 is like dead in the water. You're basically you're spending $1 to get 50 cents. Anything around 1's still kind of questionable. When you start getting up to like the 2 and the 3, I think that's when stuff starts to get really exciting. I know these are only 5 from that list. My contact details are at the end of this presentation, so shameless mid-prezzo plug. Feel free to reach out if you need to learn more or something else. Don't be shy. Drop me an email. Eric, I think this is a value that you and I both very much shares. Just be helpful to people. So you can reach out for any reason or no reason at all. Just say hi. With that, let's actually kind of pivot into 3 examples. So I'm going to walk you through 3 SaaS deals, very, very simple, with the hopes of just introducing you to how they impact your financials, right? Income statement, balance sheet, cash flow, and then kind of holding all things other equal so that we can see how these things kind of add up together, right? So let's start with customer A. It's we signed a $360,000 deal on Jan 1, so congratulations. So we have $360,000 in bookings. We billed them and received the cash up front. So billings is also 360 grand, right? Let's hold everything else constant. There's no OpEx, there's no taxes, there's no nothing else. So let's start with the income statement. So if our bookings is 360 grand, my my revenue must be 360 grand, right, Eric? And the answer, unfortunately, is no. But I even collected the cash. It's in my bank account. That must mean revenue for January is 360 grand. The answer is no. Unfortunately, your revenue is only 30 grand for the month of January, and that's just 360 grand divided by 12, right? The rules of revenue recognition don't care about cash collection. And so don't blame me, blame GAAP. Now moving up, and this is kind of where collecting it up front, creates the assets equal liability shareholders problem, is you've collected 360 grand, but you've only recognized $30 or 30 grand in net income. Where's that hole, right? So to make the equation balance, you got $360,000 as an asset, you've got 30 grand as an equity. You either have a large negative asset or you have a large liability. And so the answer is you have a very large liability. Specifically, it's called deferred revenue. Someone's prepaid you, right? Someone's given you money in advance of your service. And so technically, it's not yours yet. And if it's not yours, it's a liability. So what is our statement of cash flow? So we see that on the net income statement, you've made 30 grand. On your balance sheet, you show the 360 asset, the 300 liability, and your 30 in net income. Your cash flow confirms that, right? It says, hey, you've made a bunch of cash this month. Part of it was because you were profitable, but part of it is because someone really prepaid you a bunch of money. So let's move on to customer B, who has slightly different economics. Customer B, now it's a 2-year contract, right? 300 per year. Now we're billing monthly. So previous example, customer A, they prepaid you for the whole year. Customer B, they're just they're paying monthly. Again, same kind of assumptions, holding everything else constant, no OpEx, no taxes. So again, let's take a look at our financials, starting with the income statement. Hopefully no shocker here, your revenue is basically just 300 divided by 12, right? So you're making $25,000 per month. Since no one paid you in advance, you collect and bill in the same month. Your cash balance, your net income basically just plugs along nicely every month, and it's very predictable. And so that's really one of the nice things about SaaS businesses, is the ability to really predict into the future. You don't have to worry about, month 6 or 7 or usage or stuff like that, right? You're locked in hopefully for a year or 2 in contracts. Since no one paid you in advance, you collect the same as your bill. Your cash also, reflects the same thing. It's kind of just marching up. What you will see on the far right-hand side is you will eventually collect all $600,000. So your bookings of 600 eventually do turn into revenue. So yeah, it eventually happens, but it's over the course of 2 years that you get to collect all 600. So you'll collect 600 in cash, you'll collect 600 in revenue, and then the contract will be over. Now, last customer C, slightly different economics. This one where it's kind of billed quarterly, right? Jan 1, same deal, you landed 3 deals. This is a 3-year non-cancelable, $240,000 per year. Quarterly billings now, right? And so again, nothing shocking on the income statement. It's going to be 20 grand a month, which is just 240 divided by 12. You're collecting every quarter. So you're starting to see some of that similar swings, similar to customer A. You see that on your cash flow statement. You're also seeing that on your balance sheet, but just not as large. So we've gone through customer A, we've gone through customer B, and we've gone through customer C. Now let's see what happens when we actually mesh them all together, and how does that really mess with your financials. So here we've combined all 3. On the right-hand side, you can see that I've kind of mapped out the balance sheet, income statement, and statement of cash flows through the end of all 3 years. To remind you, customer A was a 1-year contract, customer B was a 2-year contract, customer C was a 3-year contract. So what is my ACV? What is my MRR? What is my ARR on a combined basis, right? None of the math I'm doing is crazy. I've literally just added those tables together. It's all just summed. Notice how your income statement is the most straightforward, right? There's not a lot of noise, right? And regardless of the billing differences between A, B, and C, your GAAP revenue is actually pretty smooth. The noise is actually coming from your billing, which is what causes that swing between deferred revenue and cash and all that stuff, right? So where is the kind of takeaway as a founder is, cash is king. Knowing your deals is mission critical. So, is it time to fundraise and close before a large deal is up for renewal, right? Like a customer A, really large, 360 grand, but they're only there for a year. Or are the new deals you're signing up prepaying you in advance so that you can push back your fundraise for 6 to 9 months, crush your metrics and raise at an even better valuation, right? Getting involved with your finances will help you answer some of those questions. And you may not get it perfect, but at least a model will help you think about the world in the future. So getting customers to prepay you is the equivalent of them giving you an interest-free, non-dilutive loan, right? In a growth environment, if everything's going up and to the right, depending on how far they're prepaying you, that could add months to your runway, right? And that's just good for everybody. In all three examples, by the way, and here's my kind of word of warning, is I had zero OpEx, no operating expenses, no payroll, no nothing, right? And so you were all profitable. We landed all three deals on Jan 1. And so, if you looked at our ACV for year one, it's 300 grand, which is just your ACV for customer A, your ACV for customer B, your ACV for customer C divided by 3. So your average is 300. It's the same thing for your MMR. So if you notice, our MMR for the first year was 75 grand. Maybe you've gotten confidence now that you've landed 3 deals, right? And maybe you're getting pressure from your board to go and spend some money. So you're bringing in 75 grand a month, but you got OpEx of 85, okay? Net burn of 10, no big deal, no sweat, except in this kind of world we're living in, customer A doesn't renew. And you head into year 2, still spending 85 grand, but you look at our MRR for year 2, now you're only bringing in 45, right? So now your net burn is to 40. Depending on how you spent that 85 grand, it will kind of dictate on how quickly you can rotate and kind of right size your OpEx structure. So again, the one downside for SaaS businesses is that renewal period is very risky. It's very binary, right? You either renew the guy or they walk away and use a different vendor. B2C has some more flexibility, right? They can induce with kind of coupons or something like that to induce the behavior again. B2B, the risk is that the guys don't renew and then they move on to another. And then they're with that new provider for a year. So you won't even have another bite at the apple for another year. Okay, so we brought A, B, and C together. Eric did want me to talk about kind of compounding. This has a lot to do with LTV CAC. And so no presentation would be complete without some kind of cliche person quote. In this case, I wanted to talk about compounding. So thank God for Albert Einstein. Compound is the 8th wonder of the world. He who understands it earns it, and who doesn't pays it. And this concept of churn retention really plays, it's a big component of your lifetime value, your LTV part of the LTV CAC ratio. And most of you have come across it or maybe read about it during, investing, you catch an article about the power of compounding, how it positively affects you. Well, it's also a two-edged sword, right? You can have negative compounding. And so the example on the right is, I'm just trying to encourage you to not think linearly in the sense that, in the example on the right, I start with 1,000 whatever, dollars, seats, customers, doesn't matter. And then I show month over month, plus, minus 1, 2, 5, and 10%. And at the end, you see the values of that, what it turns into. What I'm trying to show is that at a negative 10% month over month decline, from January to May, you're at about 666 customers, which means that you have to go 50% just from May to end up back at 1,000, right? And I think that's what catches people off guard. And Eric, you would ask me this question is, what's good versus bad churn? Mm-hmm. That's a tough answer because it is unfortunately kind of company specific. I've been in situations where we had a bunch of grandfathered accounts that were very unprofitable from a unit economic basis that we traded higher churn for better margins. So understand there may be a really good reason to churn those people out. Just make sure you've thought through the ramifications, right? Because at the end of the day, I still paid for them, right? Those guys who leave are still part of my CAC. So I have to make sure that I have a good path going forward, right, to monetize the people who remain, to subsidize, in theory, the people who have left. All right, last slide, key takeaways. Assets equals liabilities plus shareholders' equity. If there's one formula I can get you to remember, it's that one, right? And the concept behind it is, what's the offsetting entry is a great accounting conversation starter. So it works like a charm. Bookings don't equal revenue. I'm sorry. Again, it's not me, it's GAAP. Billings is where you get the most noise on your balance sheet. It was what's causing all that noise, between assets and your liabilities. But people prepaying you is an interest-free loan, right? And then the last is just watch out for that OpEx cost structure, right? Just watch out that, you've got the personnel that can support the business, right, to still generate, but just be mindful of those renewal periods, especially if you're in SaaS businesses where you're under 1-year contracts. There's a lot of noise around that renewal period. And then kind of open next slide for Q&A.
This is great. I just had to take a moment to read this. Wow. Miran, thank you so much for preparing these slides, walking us through this Finance 101 lesson. We have some questions that are coming in. For those of you who joined halfway in, we're speaking with Miran Ahmad. He's like a gritty startup CFO guy, wonderfully sardonic and highly informative. And we just saw his presentation. This is a recorded presentation, so we will publish this entire recording after the event as well, in case you missed some of the stuff in the beginning. But now we're entering the Q&A period. So I'm going to go ahead and stop sharing the slides for now. And let's take a look at some of the questions that are coming in. If you have a question, please post it in the Q&A section of the Zoom webinar. And Mike, good to see your face. Thanks for coming in. Do we have some good questions from the audience today?
We've got some great questions. We've got questions for Miran, for yourself, and for anybody who's willing to take them.
Let's do it.
So why don't we start a little bit higher level, and then we'll get into the tactics a little bit more. So one of the things people wanted to know, Miran, you mentioned Series A few times.
Mm-hmm.
Do you recommend a different set of best practices or slightly pared down for seed or pre-seed companies?
Oh, good question. Yeah, I think if you're seed or pre-seed, you're still trying to figure out product market fit. And so, there's the bar's even lower on the finance and accounting side, right? Do you even have QuickBooks set up? Are you even like connected? Just understand that as you grow, you may see going from pre-seed to A, B real quick, right? You may hit product market and scale very quickly. And so it's just keep it in mind that it's one of the things you have to kind of clean up, right? As I mentioned, the interconnected of all your financials means that an error 6 months ago, I still have to fix today, right? It's still running through your financials. You may still have an overstated asset account or liability account that I've got to fix. I would, for pre-seed and seed guys, focus on product market fit for now, right? Keep tabs on your accounting. Again, take some notes about things you think may be wrong or I don't understand. Because the hardest thing for me coming in kind of after the fact is trying to recreate what happened. It's a lot of sleuthing. Oftentimes I'm given emails from people who are no longer with the company or who may not remember what happened. It's easy to say, oh, I'll remember this in 6 months. Just take some notes, email yourself, right? Saying, knowing that one day you're going to give this to one of your finance hires going, I know my financials are a mess, which is kind of why I'm hiring you, right? But also, but it helps me, especially someone who's hourly or maybe working on a contract basis. I want to be efficient, right? I don't want to waste time. I want to get in, clean your financials, give them back to you so you can kind of get back to running your business. It helps me because I don't have to like ping people about their time. It's all kind of there in the email.
And just to elaborate on that a little bit, if I've just started building my product, I've got somebody like threw me $100 to try it out. Do I put that in a spreadsheet? Do I sign up for QuickBooks? Where do I start with accounting?
Yeah, I mean, if you're just kind of getting started, you don't have a lot of customers, just put it in Excel is just fine. Just kind of track it. Again, that assets equal liability plus shareholders equity is going to be true regardless of where you do it. It's just kind of build in that check. But it's really when you start to get your first customer, ideally, QuickBooks isn't that expensive. Penny wise, pound foolish. You don't need a NetSuite. I'm sorry, NetSuite. You don't need a NetSuite at a seed-ish kind of company.
We'll have to edit that part out, by the way.
But yeah, just keep it in mind, right? It's all about the right stage, and you don't think you have to do this on day one. No, you should focus on product and getting that, getting customers, landing deals, and then eventually say, yeah, okay, I need QuickBooks. I need to hire someone like me to kind of come in and clean things up.
On this comment too, like I think QuickBooks has even like a very, very small business, like small vision business version called Simple Start. It's pretty nice to actually stay within the QuickBooks ecosystem for a while before you scale up to something more mid-market like a NetSuite or whatever, Oracle in the future. But is pretty simple as a product, the simple start from last time I saw. Yeah.
Yeah.
Excellent. Okay, so potentially a question for both of you guys. So let's say that I am pretty well aware of what my lifetime value is. And just to I'll translate the numbers to something very simple. Let's say per year, I can close a customer for $1,000 a year, but I know that the lifetime of a customer is about 3 years. So I expect to earn $3,000 in total from that customer. How do I record the value of that contract?
Eric, you want to take this? I'm happy to kind of chime my opinion.
I would like for you to take this actually.
So let's clear one misconception. Your LTV, right, is a ratio, right? LTV over CAC. So the $3,000 is it revenue, or is it actual like contribution margin, right? And I think that's one of the main misconceptions. Very similar to the bookings revenue question is LTV actually isn't the revenue that you're generating. So in this case, the $3,000, it's how much are they, contributing to their business kind of after paying a lot of the variable costs that are required to service that customer. Mm-hmm. And so if you're in a B2C business where you're shipping out a product, it's the packaging costs, it's maybe the credit card processing fees is something that people debate about. But again, it's not revenue. It's kind of one GAAP equivalent would be kind of gross margin over CAC. So how much of that 3,000 actually translates into gross profit over CAC would be a proxy for kind of your LTV CAC.
Fantastic. We've got an interesting question that we don't usually get actually from the investor side of things, but I think that's the answer is going to be useful to our founders as well. So if I'm looking to write, let's say, an angel check or something, or invest a little bit in the company, how should I ask them for their accounting? What should I ask them to give me?
Oh, that's an Eric question. I can chime in. I've done a couple angel investments, so I'm happy to answer.
I'll start in this one. So it depends on the stage. So if it's like a pre-seed or seed stage kind of deal where we actually do our work at Hustle Fund, I'd say that frankly, Miran actually made a comment earlier that I think really holds true, which is a lot of the pre-seed and seed stage is more about just like product distribution experimentation, seeing like whether there's a path where the vision of the business and the service that you're trying to sell actually has product market fit. So so this is actually like why I love being an investor in this space is that the discipline threshold in terms of finance tends to be far more lax actually at the pre-seed seed stage, because it's more about like asking the questions of what happens when things go right. That said, the things that we ask for are at least trying to test to see like whether the founder is in a mindset where they can scale into learning these kinds of things. So like asking like, what are the core metrics that you care about and why? Like, how do you like measure the financial health of your business at this stage and why? I don't really care too much about, getting too nitty gritty on like the income statement and so far, because it's just a little bit too fluffy at that stage. But like understanding like, what are you measuring? And then like, what do you think you're going to need to measure in the next stage to get to your Series A? Those are kinds of things I want to see. And a lot of my questions actually are more non-GAAP at that point. It's like, well, like how much did it cost to acquire? And like, just as Miran said, what's your MRR looking like? What kinds of experiments do you think you want to run on which channels, and how expensive are those channels can be for distribution? So that's my 2 cents. I'll defer to our CFO dude here, though.
No, very similar. Ironically enough, very similar. Even though I'm finance and accounting bent, when I'm talking to early stage founders, it's much more the answer and how they think about the answer than the actual numbers. Like, how do you think about the metrics that are relevant to your business? Why is it relevant to you? Have you thought about X? Have you thought about Y? Why isn't this relevant? Okay, great, right? Because at that early stage, if they're spending so much time on their accounting, right, it actually is kind of almost like a red flag where it's like, wait, I want you to focus on more on product right now. Like right now, at the stage you're at, product and getting an MVP out the door or understanding your customer is much more important. That's much more valuable to the business than the accounting piece, right? And so for me, it's okay. Again, I think you just mentioned that's a very good problem to have. It means if you're scaling and you're worrying about accounting, it means you've generally landed a bunch of customers. Okay, that's fine.
Well, I have a follow-up question for you then, which is, when should people be engaging with someone like you? And just like, what is the right moment, you think, at what point in the company's trajectory?
Yeah, it depends on some companies engage with me pretty early. I guess a little bit different in the sense that like I've done deals where I've taken no cash. Like like hey, where people engage with me and they're like, look, I don't have any money, seed or pre-seed. Like I'll work with them on the equity piece, right? I think in the world that you see now, there are a bunch of finance players, and a lot of us are kind of going into two different buckets. There's guys like me who are like more strategic. We do a little bit of everything.
Yeah.
But we're not like hardcore CPAs. Like I wouldn't be a public company CFO. I think I'd pull my hair out. And then there's the other bucket, which is like these are hardcore, these are ex Big Four accounting guys. They're much more fitted for late stage companies and like really building out process and procedure at kind of the CDE kind of ish phase. And so the right time to engage with me is really where if accounting and finance is taking up much more of your time, there's a high opportunity cost, right? It's if you're spending so much time because you're landing great deals, you've got a bunch of revenue coming in as a founder, now it's sucking away time from like product engineering or the next kind of iteration. That may be a signal saying, hey, hire somebody else. Not because you couldn't do it, not because you're not capable of doing it, is because of the opportunity cost, right? It's costing the company way too much in like shareholder value by you focusing on journal entries and debits and credits. I'd rather you think about the world 1, 2, 3 years out, because as the founder, that's how you need to be guiding the business.
Yeah. I usually say to SaaS founders, once they're kind of approaching the Series A stage, that I hope that they're spending their time on primarily two activities, especially in SaaS. The first is whale hunting. So like you're being brought in to find the largest deals and help to close those as the CEO. This is sort of like a huge supplement on top of your existing sales team, or whomever you may have on that at one point. The second is actually recruiting, which is like, you're just constantly trying to build the best talent possible, the best talent stack into your team. So largely, and there's lots of permutations of this, but I view those as like the primary activities for, CEOs as they kind of move up the stack of their maturity. And, but often they get caught in exactly what Miran's sharing, right? Which is just like, oh man, like I got to like rework this like broken like cash flow statement here. And like I've been in Excel for like 20 hours last week. And that's a really under leveraged use of your talents at that point, where there's people way better and way smarter than you, like Miran, who can actually help you by throwing some money at his way. It's like throw money at that problem then. Like there's way better experts there.
Yeah, that's right. Look, whoever you use, whether you hire someone internally or use an external accounting, like the value is, yeah, I'm paying this person, whether a flat fee or salary or whatever it is, but like the opportunity cost is a little hard to value because it's like now as a founder, you're like, I've got this free time. Well, that's actually great. I want you thinking about the world. And this is something that I talk to founders about all the time. Like, that's why you hire me, because even if you just have downtime to think about product in the future, like that's going to add so much value to the company, because you'll actually have to like, you can think about the competitive landscape, all the things you kind of need to think about as a founder to run the business. You now have actually time to do it.
Awesome. Anything else, Mike, you're seeing?
We've got a couple of good ones that are more technical for different types of businesses. So let's say that a lot of my revenue or bookings are on something other than a monthly period. Maybe I'm an advertising company and I'm collecting towards the end of the quarter. Maybe I have an annual account, but I don't usually do services except for a couple of times during the year. So how do I even respond to MRR questions around that? How do I track MRR or how do I track those bookings?
Yeah, seasonal businesses, you see this in retail. Advertising is a good one where you may be doing a lot of work around the kind of winter season. It may not be the right metric for you, and that may be an answer you should be kind of open and upfront about why. And especially, and you'll see this with investors who know your space will be like, yeah, I completely understand why MRR is not the right metric for you. It should be this. Or you'll have investors who aren't from that space and you just need to educate them, right? I've definitely been at companies where I would get questions from the founder going, I'm getting questions from the board about this metric, and I have to explain like, this metric isn't relevant for us now, and here's why. It would be relevant in this other world where if we do this product line, yes, that's a right metric to use. So again, it's kind of going back to that non-GAAP list. Again, that list was not exhaustive. Find the kind of metrics that make sense for you. A great source is the public market. So if you as the startup have a public competitor, see what they're talking about, see what metric they use and how they calculate it. And that may be in their press release or whatever it is and say, okay, that's what the industry uses, right? If you see 2 or 3 public players use that metric, that doesn't mean that you should, but it's often a good sign that, hey, that might be a relevant metric for me to think about.
That's an amazing tip. So yeah. I hope folks wrote that down.
Following up on that a little bit, what if I'm a B2B2C company? Do I record those that second level of interaction as part of my own accounting, or is that more of a business metric that I leave to discuss with my team and investors separately?
Yeah, great question. I would probably err on the side of it's probably not your stuff to measure from an accounting GAAP perspective, but that isn't to say you shouldn't be, keeping that in for an impact perspective, or like an internal metrics perspective. So if you sell to a business, you invoice them, that's as far as your relationship stands. That business you sold to ends up selling to an end customer. That is a great thing to track because it really shows the impact you're having at the end market, right? So as you add more businesses, you may be expanding the outer layer even larger, right? You may sell to 10 more businesses, but 10x more end to customers. Well, you want to measure that impact because that's who you're really influencing.
That's great. While we're collecting a couple more questions, I think everybody wants to know from both of you guys, Miran, how do we learn more if we want to get smarter about accounting? And then follow up to that, Eric, how do we learn more about the metrics that our business should be tracking at an early stage? What are some templates and resources?
Yeah, great. Thank you. So, by the way, I just reshared my screen. Hopefully you can see it. And Miran can sort of explain, but if you've been impressed by what you heard today, we have, Miran has offered actually to share his contact information really widely. So this is actually one way that you can speak to him. As you can tell, like he fits actually a very specific kind of persona of a CFO, one that's actually not like your accounting nerd who like hides in like dark corners, just like crunching numbers. He's actually a very strategic partner. This is actually why we're so attracted in reaching out to him for help on this topic, because he actually really does think like a founder, like a business strategist, more so than even like a finance person, but he happens to be really great at finance strategy and loves it for some crazy reason. But like when it comes to some resources that we use, so I'm a big fan actually of Elizabeth's blog, my co-founder, elizabethyin.com. She actually talks a lot about instrumentation and metrics. So that's a good place to start. When it comes to, talking with us, when we're going to be in conversation about your business, I'm going to be asking you a few things. One of which we actually have talked about in this Q&A quite a bit, which is what are you measuring and why? So at the pre-seed stage, and this is actually a little bit more than just finance. It doesn't necessarily have to be revenue. Like, depending on what your business is doing, you might still be in a building phase, and you might find that it's like lines of code. You may find that's like pilots. You might find that it's some other kind of heuristic, and that's fine. I just want to get a sense of like, how do you think about this business at this stage? And then how do you think about like what you need to measure in future stages? I know that's a little bit hand wavy, but it really does vary based on the business and the set of founders too. So prepare yourself for that question. And I think that's a question that a lot of pre-seed stage investors are looking at. If you have a little bit of traction, there's always like a very simple question I have in the back of my mind, which is this a business that's going to be a going concern or a science project? I have a very simple definition of what a going concern is. It's a business where more money is going to come in than leaves over time, right? And that's, I think, the most basic definition of a business I can think of. A science project to me is just like, we're so in the tech. It's like, amazing. We're going to be mining gold from like asteroids in the future. And that's cool. I can see actually a lot of money being made there. But, if a founder is not really business oriented in terms of really trying to make a serious crack at building a going concern, it's not going to be a fit for at least our fund. Right. So I think, at the end of the day, I'm not sure if I've shared this with like a lot of people here, but I actually have a tradition where at the end of the day, like me and my son, we usually like, get ready for bed together. I put on his pajamas, comb his hair, brush his teeth, and I try to pitch him a company that has pitched me that day as an exercise. And the 5-year-old, the pitches that actually work best are the ones that actually find myself, we both tend to find natural excitement together, are those where just the business model is super simple. It's just like, look, you know, I give you 5 Star Wars Legos and then you only have to pay 2 to this other dude. And then like, we just do this every day and you're going to accumulate like a ton of Legos, right? Like versions of things like that. And I really like need that kind of level of 5-year-old sophistication as a VC to just like get excited about those kinds of businesses. Anyway, I spoke a lot there. Miran, I don't know if you have any feedback. And also please like talk more about CFO.
Yeah, I have this website. It's probably just a landing page. I turn it on and off as I have full-time employment or not. Like right now, I'm just enjoying some contract work. So I have my own email at there. Look, thank you, Hustle Fund. Thank you, Eric, for having me. You know, I know there were a bunch of questions that we didn't answer. Feel free to shoot me an email, connect with me on LinkedIn. Again, Eric and I, you know, we share this value of just being helpful. One of the companies I'm working with now, I talked to them 3 years ago, and I only started the engagement a couple months ago. So like, you know, if I can be helpful in the meantime, introductions. If the stuff was too confusing, you want to go over it again, happy to do it. If it was too basic and you want to like go into more deep dives, I'll leave it up to Eric if there's enough feedback for maybe a follow-up session or something like that. I'm happy to do it. If I didn't or couldn't answer your question, shoot me an email if you need some help or know someone who does, or if you just want to say hi, right? Like you know, like you said, I'm pretty lively. You know, I try to play video games, have a life outside of finance and accounting. So like, just say hi. You know, we can chat and grab coffee when this is all over, and you know.
Yeah, absolutely. Thank you so much, Miran, for offering that. And it's kind of just for the founders out there who are at the stage where I think having an advisor or a consultant like Miran makes sense. Like it's a very lucky window that we have right now, where he's just kind of just kicking it and enjoying life. Miran, you're taking I think a well-deserved break after like a seriously amazing run of companies that you've led as an executive. So I'm glad that you're actually still trying to build that PC that we were talking about earlier on the side to do.
Yeah.
A tiny bit of gaming.
My wife cleaned up the background. There's a bunch of like PC boxes that she's like, you can't show that stuff. And I was like,
No, it's all good. I'm in my garage where there's 5 garbage trucks and a child's potty right there. So, you know, if you want to talk, your wife can come over, by the way, and help me, you know, tidy up my organization here too anytime. So I think with that, we're going to go ahead and wrap. But we've been speaking with Miran Ahmad. He's the longtime CFO, finance executive at a number of great companies, most recently Truepill. He's been walking us through an insanely great 101 lesson on finance for B2B companies. I want to make another shout to Netsuite for sponsoring today's session. You know, Miran has worked with Netsuite. A lot of our companies at Hustle Fund work with Netsuite. I hope that you check out netsuite.com as you guys think about growing too in the audience. And thank you so much for joining. We know that you're busy. Appreciate your giving us an hour, and we hope that we can see you in another session. So good luck. Remember, bookings is not revenue.
Bookings is not revenue.
I just got to say that one more time. Thanks so much, everyone. Thank you, Miran, again.
Thanks, everybody.
All right. Peace out.
Bye.
Bye-bye.